All right, everybody. So my guest today is Ryan Floyd, who's the co-founding managing director of Storm Ventures. They invest in and work with early stage enterprise SaaS companies. Typically, they get involved when companies have a handful of customers. Ryan also hosts a popular YouTube channel, Ask a VC. So thank you very much for being here, Ryan.
Yeah, no, happy to be here. Thanks for having me.
Definitely. So maybe we can talk more about Storm Ventures. For people who are not from the VC world or the startup world, how would you break down what you guys do? Are you a VC fund? Are you an angel investor? What is the kind of stage
Yeah,
or typical
yeah,
investment?
that's great. Set some context. So we're an early stage venture investor. I started investing with Storm, started the fund 20 years ago, believe it or not, right after the first crash, the internet crash in 2000. And we're investing out of our sixth fund right now. And we do early stage B2B SaaS. So, we're looking for companies that are targeting enterprise or business buyers. And that, could be all the traditional enterprises to, it could be SMB buyers as well. But it's always got a business buyer on the other side as compared to, say, a consumer end product like Uber or DoorDash or something that's really targeted at consumers. And then most of what we're investing in today is SaaS, because that's just where a lot of the action is in terms of what's interesting. And so, we've been software investors for the last 20 years, but SaaS has obviously really taken over. And then we invest across all the categories. So, from security to CRM, marketing automation, and so forth. Really anything that's got a business buyer.
Mm-hmm. Yeah, I've heard this a lot from VCs that B2B SaaS is more stable than investing in B2C companies because the revenue model is very uncertain with the B2C mobile apps, for example, where we have three of them, so I know. And so why did you decide to go into B2B SaaS? Was that in the 20 years ago, right? So was that from the beginning, or did you also experiment with angel investing also in the consumer businesses, or how did that come about?
Yeah. Well, first of all, I tell you, I'm not sure B2B SaaS is any better than consumer investing. I mean, I think you can make money and build great company. To being, I think, a good investor is, knowing what your strategy is and being able to execute it. And I do think it's pretty hard to be an investor and be good at everything. I think like anything in life, you have to focus. And so, we've chosen to focus on B2B. Part of that is self-fulfilling prophecy. I mean, we've made a lot of money there. We've done well as an investor in B2B. And that, creates a network effect and helps us, I think, find success. I think it's also just an area we've collectively, when we started Storm, we had a lot of experience in selling to business buyers. We weren't consumer people. So I think that just, that's just kind of where our, kind of gravity pulled us. And the last thing I'd say is, like, from a strategy standpoint, I think we've really figured out that in the B2B world, the go-to-market challenges, maybe we can spend a minute talking about that if you think your listeners are interested. Mm-hmm. That's a lot of what drives success in B2B. It's what I think can be repeatable. And it's where you can really draw lessons from other companies. And so we've got a strategy around really focusing on helping companies with that go-to-market fit. That doesn't really apply in consumer. Consumer is a very different dynamic, or life sciences for that matter, or energy or other sectors.
Yeah, especially if you have like a B2B SaaS company, you can maybe even do like a consulting gig for, I don't know, like 5 figures on the side of that business to give you some cash, which you can't do with consumer product, I guess. So maybe that can also be
It can. Yeah, I mean, you're right. I think there are some options that are maybe open to companies selling to businesses that you can't do as a consumer if you're selling to consumers. But just in the service example, I think that can be challenging too, because it doesn't scale very well. And so it may make you feel good in terms of like top line revenue, but it's obviously not recurring. Yeah. It's not really a lot of leverage on product. And frankly, with consumers, a lot of these direct to consumer businesses, they're really about getting a channel to a customer. And once you have that channel created, you can put a lot of product through it. And so, there's advantages to that model too, which are, I think, interesting in themselves. I think of them as just being really different.
Mm-hmm. And so when you started 20 years ago, were you an entrepreneur before, or how did you get involved in this world?
Yeah. So Not really an entrepreneur. I started out. My first job was effectively cold calling, what you call in B2B SaaS today
Mm-hmm.
an SDR.
Yeah.
Except instead of working for a product company, I was working for a private equity firm. And so I was trying to source new opportunities for that private equity firm. It was a fantastic first job, and that's kind of what got my feet wet in terms of private equity and investing. And
Mm-hmm.
from there, I went to go work for an optics company that was later stage that we then ultimately took public in '98. And then we sold that company to another telecom company in 2000, and that's when I joined Storm. So I think, I have, I think, some empathy for entrepreneurs, not only because I've worked with them for 20 years, but I started Storm and the ups and downs of like trying to get a venture firm off the ground.
Mm-hmm.
But no, I really can't claim to have gone through that same entrepreneur journey that, many others have.
Yeah. So your background is more sales and marketing, right?
Yeah, I'd say operating. I mean, I think,
Mm-hmm.
I really, got a good operating background at the optics company that I was at years ago. And really, to be fair, a lot of that's ancient history now because, I started Storm 20 years ago. So a lot of things that were relevant then, aren't so relevant today.
Yeah, I have a similar background. I was cold calling for like 3 years as well. So it's a good first job.
It's a great first job. It really is. Yeah, you learn a lot of ways to hustle and how to communicate with people, how to drive resonance, and sales is really, I think, the engine for most companies. And so, really, kind of getting a really good understanding of that is pretty important.
And so you've been doing this for 20 years, and this is your sixth fund. So what are some basic rules in the US for a life cycle of a fund? Is it between like 5 to 10 years? And like, how does it work from like a logistical perspective if you set up a fund?
Yeah, so I mean, it's changed over the years. I think the holding periods for investments has elongated for a bunch of reasons. But the biggest one is that companies are going public much later now, and so the companies that are public are much greater in size, and so the companies that they're looking to acquire are often much greater in size, and so I think companies are just staying private longer, especially with plentiful capital available. And that then, will elongate fund cycles. So typically for a fund, it's 10 years. That's the way of most funds are set up. I mean, obviously there's a lot of variation, but, most funds are set up for a 10-year fund cycle. You essentially are investing new dollars in the first, 3 years or so. And then the balance of the dollars are reserved for follow-on investing in the fund after that. And so, a lot of funds will raise new money after either that 3-year period or sooner if they've already deployed the capital. And certainly over the last 10 years, funds have been deploying capital very quickly. And so the average fund cycle of raising subsequent funds has been certainly under 3 years. It's probably been closer to 24 months, if not even under that.
Mm-hmm.
And then, and in terms of the overall life of the fund, that depends, I guess, on the assets that you have in the fund at the end. I mean, just to give you an example, we closed down our 2000 fund 2 years ago. So 18 years after starting it, which just seems incredibly long. But a couple of things to remember. First, we weren't collecting fees on that fund for many, 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 many years. But we were managing it because, we had our own personal economic interest in that fund too. And we had an asset that was of value that, made sense to keep the fund open. And then also most of our investors are institutional investors. They're pension funds, they're endowments, family offices that are thinking about the long term. And so long as we aren't collecting fees and trying to milk some time frame, and we have their economic interests at heart as an LP, most are okay with a longer fund cycle. What they want to see, however, is cash returns. So I think, no one wants to invest in a fund and wait 18 years to get returns. But, in fund 2, we returned all of the capital much sooner in the fund cycle. And it was just one remaining asset that kept that fund open.
Mm-hmm.
Anyway, it's
Got it.
probably a longer answer than you wanted, but yeah, that's
No,
the
it's
basic.
cool.
Yeah.
So maybe you can break down the early stage investing. Maybe what is the usually the ticket size that you invest in, and in which stage of the startup life cycle does the company need to have is it enough to have a prototype with a couple of customers, or do you need to have like a fully functional product with I don't know, like enterprise logos already? And is that in Series A, or do you get involved before in like seed rounds?
So obviously it completely depends on the fund that you're talking with in terms of what the rules are. For us, what we look for, because of the strategy I mentioned earlier about really trying to help companies with go to market, our bias is towards companies that generally are like $1 million in ARR and growing, maybe even slightly larger, especially with like kind of current events. I think, our shift is to go, look at companies that have some evidence of product market fit. So it's beyond just a product and a couple of customers. It's actually some revenue, and really looking to find a partner to help them scale that go-to-market phase in the business. With that being said, there's a lot of early-stage investors that have different filters that want to be the first investor in, or looking for pre-revenue opportunities. Maybe they only want to see one or two customers. So everyone kind of has a different filter that they look at. And then we're typically writing somewhere between $1 million and $5 million checks into companies where we're going to be active investors. We're generally going on the board. It's not a requirement for us, but it's often the case. That's why people want us to invest, is to be active. And then we reserve a significant amount of capital for follow-on investments in subsequent rounds.
And so, how long does it take from the time that you receive they receive a term sheet until you invest? Is that like 4 to 6 weeks, or does it take for maybe even 6 months to do the whole due diligence process?
It's a hard question to answer because it really does depend. We've got a fairly small investment team, so we can move very quickly. But I would say, if I had to just guess, like kind of, say in general, the timing is the most indeterminate amount of time is between first meeting to a term sheet, because in that period of time, we have to answer the big diligence questions. We're not going to sign a term sheet with somebody if we've still got major business diligence issues outstanding. That wouldn't make any sense. So answering all those core questions, that's going to take time depending on how easy those questions are to answer, and and sort of how we feel about the overall opportunity. With that being said, in general, it's certainly under probably a month for us. It's probably closer to like 2 weeks or so, I would guess, for the companies that we really engage with and spend resources on. There are a lot of companies that we're engaged with that time frame gets elongated because there's some challenges on the diligence side that we don't have good answers to. But we try to be very upfront with the entrepreneurs about where we are in the process, because I think that's just really frustrating for a lot of founders, that it's a black box. They don't know what's going on. They don't know what the next steps are. So we try to be very clear about where we are and what questions we have to answer, and if that means they don't want to spend time, that's a decision they can make as well.
And so from, let's say, 200 business plans that you look at, let's say in a month, which I'm assuming, how many of them end up on your table and possibly investing? I've heard it's 1 from 100 or something like that. So do you have any answer?
It's hard to give, I could give you crazy metrics if I looked at like the number of quality, kind of qualified opportunities that we see, and then ultimately what converts into deals. And it's just, it's such a small percentage that, and it's hard to compare, because what I consider to be quality might be different than, somebody else. Right. But I would say at any given time, the team is engaged looking at a handful of opportunities, and we'll probably close 1 new investment a month on average, something like that. So kind of think about it, maybe 10 new investments a year. Although with all the current events, that may not be the case, but historically, over the past several years, that's sort of been the pace that we've been on. And that means, at any given time, there's, a half a dozen investments that are being evaluated by the team. And that's what we talk about on Mondays. And we, kind of go through the challenges and the opportunities and what gets us excited, and, where we want to dig in more. And then that drives the kind of next steps.
And so Are those business plans or those entrepreneurs coming to you from your network that you built over the years, or is it even possible to get in touch with you and get an investment through like a cold outreach, or like if I don't know you or nobody refers me to you? Have you ever done that?
Yeah. So it's a great question. Most, I'd say, probably 80% comes through our network, but network is very loosely defined. I mean, I've been an investor and I've been working in Silicon Valley with tech companies for 20 years. So there's a lot of people that, I've come in contact with over the years, great executives of prior portfolio companies, and, not people that I see on a regular basis, unfortunately, but, they know who I am and they had a good experience. And so, there are a lot of referrals that come in that way. But with that being said, I think increasingly, we see good opportunities come in cold as well in emails. In fact, that's how we met, and that's and that resulted here in us having a chat today. So I think it's a strategy that entrepreneurs should use, and it's probably worth just mentioning though a couple of things the way I think about it, because I know it's very frustrating for a lot of founders. They send these cold emails and they don't get a response. And so at least to get my attention, and, what I really value is number one, it's got to be targeted at me. And what I mean by that is, it needs to be sent to me, or the opportunity has got to be something that's relevant for me. So we just got done talking about the fact that, we do B2B, for example, right? So if you send me a consumer opportunity and you're really excited about your new social networking idea, look, I'm not your guy. I mean, it may be a phenomenal opportunity, but I'm just not the right guy. And so that's not going to get a response. And while I may read that briefly, I'm not going to respond to those emails. The second thing is really to keep it short. Look, I'm not an English teacher. I'm not interested in reading your essay. I want people to be to the point, and tell me what the metrics are, or why they think I ought to, take a hard look at this. And it's just not me being overly critical, but like, I don't want to read and sift through a long email that goes on and on about things, when my filter is pretty simple. I just told it to you, right? It's B2B SaaS. It's $1 million in ARR and growing. If you fit those criteria, it's likely I'm going to take a meeting with you. And then, and I guess, in terms of follow-up, I think sometimes founders are frustrated that, they don't get a response immediately. And like most people, I struggle with time management like everybody. So I think it's okay to send another note, 3 days, 4 days, 5 days later. But if you've sent like 3 or 4 notes, I've probably seen your email. I just haven't had the time or interest to respond to it. And that's probably true of most. So for whatever reasons, which founders might find frustrating as well, but it likely has to do with my filter or something. The last thing I'd say is a lot of founders reach out to me on LinkedIn, and this is just a personal thing for me. Look, I love LinkedIn. I'm on it every day, but I really think their email system sucks. I'm not a fan at all of doing LinkedIn messages. The threads are terrible. There's no way for me to keep track. There's no search. I just could go on and on. I wish it could get integrated better with my existing email flows, but for whatever reason, LinkedIn doesn't want to do that.
No.
So I encourage all founders just to send me a note directly. And it's not like I'm hard to find. Like I'm easy. It's Ryan@stormventures.com. I'm really easy to find. Yeah. So there really isn't an excuse not to do that. So you may not get, so if you hit me up on LinkedIn, you may not get a response from me, because I have got this YouTube channel going right now that, I get a lot of inbound on Ask a VC, and it could just be hard for me to much harder for me to respond and keep up with it on LinkedIn.
Maybe they should leave you a comment on YouTube.
It's a great, that's creative, right? I read all the comments, partly because, I don't get a ton. I'm pretty niche in terms of who I'm targeting. But yeah, it's a great point.
Yeah, I also have a channel about basically cold outreach. I have like 1,000 subscribers, so I read all comments from founders, and if somebody emails me, I might not read that as well. So, and the LinkedIn doesn't want to open their API, so they will never do that. So that's why they never get integrated with anything. So it's just
Yeah. I mean, they've got the reasons. I get it. I'm probably not LinkedIn's target market. So I get it. I get it.
Yeah.
They're not building product for me.
I would say also for people who are listening, it's all about the offer. Like because I'm involved in B2B SaaS, so maybe in the future I might build a B2B SaaS startup. And I already know you now through the podcast, so I have a reason to follow up with you. I need to send you the link to the episode, right? And maybe in like 7 months, I can send you an email. You already know me, so it's going to be much easier for you maybe to take the meeting with me than if I just didn't know you. But I would just recommend people to have like something to offer to people of value. Like if I want somebody to connect with somebody, I invite them to a meetup as a speaker, or to a podcast or whatever, or to a ski trip. I invited the unicorn CEO, which I would never thought he would respond, and he did respond to a ski trip. I was like, that's crazy. So like there's ways to do this, and if you have a great offer before you ask anything, right, then you can build a relationship and then ask something.
I think it's a great point. I mean, and I don't even think you need. I mean, the ski trip is is pretty creative, but I think just even like basic stuff, like if to your point about knowing someone, if I'm investing later than where you are, this happens all the time. People are really disappointed that I'm not investing pre-revenue.
Mm-hmm.
And look, I'm happy to stay in touch. And people should send me updates on how things are going and where they are. And when they get closer to where I would invest, you're absolutely right. I'm much more likely to take that meeting because I already know who they are. Now, the same email rules apply. I don't want to read, 2,000 words of a summary of the business, but, to the point and a good use of time. Because to your point about what I get out of that, look, I mean, I learn a lot from meeting smart founders, and what they can offer is insights into their business and their market that, I don't have. And that's something every single founder has at their disposal. Even if they can't offer a ski trip or offer something else, they have more to offer maybe than they think to maintaining those relationships.
Mm-hmm. Exactly. And so what's your take on the current situation? Right now it's March 17th and we're in the middle of coronavirus. I don't know, maybe this will be released in May, so maybe it's going to be ended by that point. But what's your take on the VC investing, early stage B2B SaaS in this kind of environment?
With the
Is
current
it going to
events.
slow? Is it going to slow down? I know there's a ton of downside on the market right now, but also there's some companies who will grow, like Zoom and all these things, remote work and all collaboration tools are going to pop up because this is a need at the moment. So what's your take on this market?
Well, boy, we could probably spend an hour talking about that. But maybe I'll just give you the crib notes that I told our LPs actually yesterday. So we're pretty concerned, and I'd say obviously a lot of people are concerned as well. But the reason I think I'm maybe more cautious and concerned than a lot of other venture investors right now is that I don't see a clear end game outside of a vaccine, in which the timelines, even the best case, it's a year from now to mass distribution. So we're talking about maybe some antivirals that could have some efficacy, and that's really what the hope is, that could get us kind of back on track, which I just don't have a lot of visibility into where we are with those and testing and so forth. But I'm hopeful that that's going to be our way out. But absent that, I don't know how we get back on track in the near term, because, here in the Bay Area, they've instituted this lockdown into April. But if we don't have these antivirals in April, are we going to all go back to work? That doesn't seem likely. And I just don't see, with these restrictions put in place, businesses are going to just suffer tremendously. There was a news conference this morning. The White House administration announced that they wanted to send checks out to all Americans. But all these tools are so blunt. What's really different, I think, than like 2008 here in the US, when the financial crisis was, while that was incredibly scary because of the massive kind of structural financial issues, you had, in a way, government had an ability to deal with those issues directly because there were fewer players where they could really help contain it and really get things going again. And I think, a lot of credit goes to the prior administration for being able to basically get things back on track. And within a year, under a year in venture, things were, back to normal as almost that they had never happened. With this situation, however, we've got a major income problem with all of the businesses that are going to struggle. And I don't know how that problem gets solved. Again, outside of us kind of all, getting back to normal. So as a result, I guess and we'll know in May, it'll be interesting when this comes out and we all listen to it. I think we're going to see a pretty dramatic slowdown. What happened in past crashes was, you saw venture investors became very slow to invest in new businesses, in large part, at least initially, because we don't have to. There's no compelling reason that I need to go out tomorrow and fund a new company. I'd like to. I mean, I really would. We're meeting companies and we're excited about investing right now. But I think, the psychology affects everybody, honestly. And anybody that doesn't admit that, I think, is kidding themselves. And that, depending on how long things go, could make it very tough on a lot of startups. Stating the obvious, the biggest reason for that is, most of our companies are unprofitable, not just Storms, but, startups in general. So they need to raise money in 12 to 18 months, if not sooner, for many of them that maybe raised money 6 to 9 months ago and we're trying to grow quickly. So that just creates a lot of stress. And boy, I'm just hopeful that, there's an antiviral that, shows some efficacy in the next, couple of weeks, 30 days, that gives everybody that sense that we can go back, that we can suppress the virus and get on with things. But we'll see day to day.
Yeah. I mean, it's not just US, it's every country in the world. It's crazy, everywhere.
Yeah.
So it's like globally a problem. And I don't know.
I mean, I've heard anecdotally through people that do business in China that a lot of the Chinese supply chain is really getting back online right now, and people are going back to work. And what I've been told is that for a lot of those people, it feels like things are getting back to normalcy. So I can hope that we follow a similar pattern, I suppose. But, it's hard not to look at, to your point, it's a worldwide epidemic. It's hard not to look at Italy right now and be, very, very concerned about what that means for, so like the US, where we're maybe 30 days, 2 weeks behind Italy with the spread.
Yeah, every day counts. I think in China, they all listened to the government. So when nobody got out for, I think it was 4 to 5 weeks, now they can just go to work. The streets are full. People just have to wear the masks, and everybody gets a temperature check at each corner of the street. But if you're not sick or old, you can go out. So that's the Chinese way to do it. And they got out of it. So, yeah.
Yeah, well, we should take some lessons from that, right? I mean,
but it's hard in the West, right? Because people don't want to listen, and it's better if you have a dictatorship where you can just say,
right,
just do this, and
right.
Everybody.
No, you're right. You're right. Yeah.
So we'll see. But anyways, I mean, this was a great take on the market. So thank you again for being here. Where do you want people to go to if they want to connect with you or find out more about Storm Ventures? Maybe they have a B2B SaaS company. How can they get in touch with you?
Yeah, it's great. Well, so I've got a YouTube channel that I've been playing around with. It's called Ask a VC. So you can see a lot of the content that I've put out there. I mean, how to put together a pitch deck, how to do remote work, which is very timely, that I'd done months ago. So you can go there, check that out. I'm active on Twitter. My handle's at Ryan Floyd. And then of course you can always email me at, Ryan@stormventures.com.
Awesome. So guys, if you have a B2B SaaS company, go ahead and connect with Ryan on LinkedIn, leave him a comment on YouTube. And thank you, Ryan, for being here and sharing the insights.
All right. Well, thanks for having me. All right. Be safe.